Hey, everybody. Thank you so much for joining. This is part of the CWDL webinar series on key mortgage topics for our clients and friends in the industry. Relationships are definitely key, and warehouse banks play such an instrumental role in the mortgage banking space. We couldn't be more honored to have the group offering insights today. Today's discussion will take a behind the scenes look with leading warehouse lenders Susan Johnson with Scale Bank, Rob Marr with Wintrust, and Mark Short with Alliance Bank. CWDL's very own Dustin Pfluger, again, the man with the mustache. He's going to moderate this panel today and keep us on focus. So that said, we like to keep this as interactive as possible. So if you do have questions, please feel free to type them in the chat. Again, we want to make it relevant and interactive. So if your question doesn't get answered, we'll make sure somebody does follow up with you. Other than that, I'm going to kick it off to the experts.
Well, thanks, Casey, and thanks group of y'all for doing this. I think we were talking about this before. We did this about 2 years ago or so. This same panel of warehouse experts. Susan is the only recurring one. At that point in time, I think it was the exact week that Comerica exited the warehouse space. So we were scrambling, got some stuff, but luckily now we have Rob with us, who was at Comerica and now with Wintrust, and we're not quite as turbulent in the warehouse space as we were that week at least. But I think getting started, what I wanted to do, just kind of get everybody going and get the conversations going. It's just kind of, if we want to go through, I go in order on my screen. It's Rob, Susan, Mark. If y'all want to just each give a brief background of yourself, where you've been, and we have such a deep pool of experience here that I want to kind of give your background for everybody on the call first before we jump into the questions and whatnot. So Rob, why don't you jump in if you don't mind?
Sure thing. Thanks, Dustin. Thanks for inviting me onto this panel. I'm Rob Marr. I've been involved in the mortgage industry in one form or another since 1992. Started warehouse lending way back in 1995. Most of my career was spent with Comerica, as Dustin just mentioned, about 28 plus years. When they did decide to exit the space, my team and I picked up and moved over to Wintrust, and we've had a great time with our new family. And currently I lead a team of 5 relationship managers, and we cover the country.
Awesome. Thanks, Rob. Susan, how about you?
Sure. Susan Johnson, Scale Bank. We were known as Fidelity Bank up until about 2 years ago. We went through a name change. No change in ownership, management, markets served. Purely a name change, not to get confused with that other or multitude of other Fidelities that are out there in the world. My background, I actually been with the bank now for 35 years. We've been in the warehouse space since the mid 80s. And I started out as a C&I commercial lender, but always thought that warehouse business that was off on the side looked kind of interesting. And we had an unfortunate event that happened here in 2002. The gentleman who was running the warehouse space died of a sudden heart attack on the golf course. And so they were really looking for somebody to step in and start working with some of those relationships. I was asked, what do I know about mortgage? Said I have one on my home, and I need this job to make the payments on that. So I really stepped into that spot, and I've been there since 2002. We serve a wide variety of companies across the country, from emerging mortgage bankers that really get managed out of our office in Houston, Texas, to larger correspondents, probably doing facilities up to about 75 million.
And I know it brings up all the time, Susan, to you, but you've got to be the longest tenured warehouse banker at one consistent bank now.
I think I'm the old lady of warehouse.
Well, I didn't mean it that way, but I mean, especially now that Vaughn and Comerica's out, yeah. I think you have to be the longest one out. I mean, that the longest at one bank. So
I think so.
So I guess congrats on that.
Thank you.
Okay, Mark, why don't you jump in?
Sure. So I'm Mark Short over at Western Alliance Bank. I've been in the banking business for about 28 years. And 23 of that I've been covering mortgage companies. So like I said, I've been at my current position I started during COVID, so it's been about 5 years. And now I'm the sales manager at the bank. And, we cover warehouse financing and mortgage servicing right financing. And my background before that, I started Bank of America back like in 1998, and I was actually on the credit side of the bank. So I had about 15 years of credit work where I was underwriting deals for mortgage companies before I jumped over to the sales side in 2014 and worked for Wells Fargo for about 7 years. So 15 at Bank of America, 7 at Wells Fargo, and then about 5 here at my current spot at Western Alliance. So like I said, the majority of that's been covering mortgage companies, either credit or on the relationship side.
Perfect. Well, thank you all for that brief intro. Just want to go through. So just a couple things. We're gonna run through a few topics. We got some standard topics. We're gonna run through just in general that we kind of created, came up with, asked some feedback, got some different stuff. So we'll cover a wide range of just current issues in the warehouse space, how to communicate with warehouse bankers. We'll talk a little bit on some of the accounting treatment and how warehouse banks look at some of these key issues. And then we'll get into some other topics at the end, and we'll kind of rapid fire through stuff. If we have time, maybe talk a little bit about M&A. But as always, I mean, ask questions. There are questions here to be able to ask. We monitor the questions, so if you bring up questions, if we don't get to the question or for one reason or another, just don't answer it on the warehouse, we will get back to you guys and respond to it. So please feel free to ask questions. It kind of helps it flow, helps it keep going, that kind of thing. So I guess with that, I mean, I think just starting off just kind of broad. I mean, why don't we jump into it? And Mark, if you want to go first, go reverse order now. Just talk about the current, the current issues and trends that y'all are seeing. We can talk about, expanded product, market volatility, covenant stuff, just a wide range of just what you're kind of seeing out there.
Yeah, I mean, I would say it's been very tough in the space for a long time, but over the past few quarters, profitability has improved. I mean, I think our entire group, the entire industry was sort of stuck with doing profitability waivers for a really long time. If you look at the fourth quarter, about 77% of our companies in our portfolio were actually profitable for the quarter. So that was a lot better than what we had been seeing like in 2023. So profitability is better. I mean, I'm not saying it's like robust profitability, but definitely a lot better than it was. The MBA, I think, it had about 60% of IMBs were profitable in the fourth quarter. So our portfolio outperformed the MBA average a little bit. As far as products go, I think we're starting to see people sort of look for different, whether it's second liens, constructions, kind of maybe a little deeper into non-QM markets. So we have people looking at kind of your DSCR products on non-QM, things like that might have a little better margin, but just trying to look for ways to increase their production. So that kind of covers the profitability piece and what kind of what we're seeing on sublimits. Our bank particularly is fairly flexible on sublimits as long as the credit quality of the IMB supports it. We do the majority of the sublimits that are out there.
Awesome. Thoughts? I have a couple of questions I'll follow up, but thoughts, Rob? I guess why don't you jump in?
Sure. Yeah, I would agree that, I guess right now the biggest issue that I see is volatility. If you would have asked me a couple of weeks ago what I thought was going to happen, rates had kind of dropped for a couple of days. It felt like there was a lot of momentum and potentially a little refi boomlet out there. And then last week happened and all that reversed. Talking to a number of company owners, and they're like, I don't even know how to price something right now just because of all the volatility out there. So I think that's probably the number one issue. Much like Mark said, we outperformed the MBA's report as well. For the year, about 75% of our companies were profitable for the year of 2024. January, February, traditionally tough seasonal months. March was a good month for a lot of our clients. And again, they had a lot of momentum going into Q2, but now that's a little bit tempered. In terms of covenant violations, we really haven't seen many because we choose not to do a profitability covenant. We view it more as a make work covenant because we really always look to the liquidity and the tangible net worth of the company. And if they have sufficient liquidity and tangible net worth to handle their business and potential future growth, we can be very patient.
Got it. Perfect. Susan, you want to jump in?
Yeah, and I'll probably echo a little bit of what both Rob and Mark have said already. One other thing, though, that I think that is maybe a little bit different that we've been seeing is I think it maybe has to do with just the volatility in the warehouse space with banks coming and into the space, leaving the space. One thing that I've kind of been noticing is that clients are tending to have maybe more warehouse lines and they might be smaller. And I think they're doing that because they don't want to get caught by surprise if their warehouse lender all of a sudden says, hey, I'm leaving the market. So that was just kind of an interesting thing I've been seeing over the last year. We also are seeing more requests for non-QM product, some of those other things, reverse, second mortgages, that type of thing. And kind of some questions we always ask our clients is, how much of this product are you doing? So are you an expert at it? If you're not an expert at it, how much of it are you willing to bank versus broker? Are you doing the underwriting on it or not? Who are you selling these loans to? Is it something that can be kind of portable? So that maybe if that one non-QM investor doesn't like it, you got another outlet for it. So we talk about those things with them. And then as far as covenants go, a little bit more like Robin, that we don't have a lot of the profitability covenants. But we look at covenants as being, yes, they're in place for credit reasons, but also to just prompt that discussion and really wanting to understand what the plans are to get back into compliance. Is it a short-term issue? Is it something that's longer term? And one of my favorite stories to tell about covenants is the best way I've ever seen it handled was I had a client who called me up before he sent his financials. He said, hey, heads up, I'm sending this over. I'm going to be out of compliance with this particular covenant. Here's why, and here's how I'm getting back into covenant and when that's going to happen. I mean, that's a nice layup for a banker to have.
Well, that's a good, I want to go back to the profitability thing here in a minute, but since you transitioned there nicely, let's talk about that for a minute. I mean, we get that question sometimes, like, oh, what do we do? Do we tell our warehouse banks? Do we try to, I mean, I guess you gave your thoughts, Susan. I mean, Rob, from your perspective, I don't want to assume anything, but I'm assuming similar. I mean, communication is always key, right? I mean, if you know, you can deal with it, but go ahead, give your thoughts on that.
No, I think communication is totally key to the entire relationship. And, we truly appreciate a proactive reach out on something like that. One of my favorite clients from years ago, he was so far ahead of the game. He would be like, Rob, I'm looking at our forecast and like 8 months, we might have an issue. Can we address that now? And that's always, I mean, that's to the extreme one way, but it's way better than, hey, here's my compliance certificate. And oh, by the way, we're out of compliance and we have no heads up notice. So communication both ways is key to a great relationship.
Mark, anything you want to add there on that piece?
I mean, I 100% agree. I mean, given with the credit background, it's always best to get in front of it. The problem, they're going to find out at some point anyways. And if we don't have the advance notice and what the plan is even if you don't have a plan to fix it, the advance notice and talking to your warehouse banker about maybe getting ideas from them about what you can do to fix it, or what do they want to see to fix it, just to keep the line open. The advanced communication is always going to be, even if you don't have the plan fully baked out, the better you can relay that message to your warehouse bank, the better off you're going to be. And for us, it's like, I think everybody in the space, cash is kind of king, and we look at the cash covenant the most, and how much cash do you have to cover losses. When that gets down to a certain level, it's going to start to become concerning for a bank. So if you don't know what that level is, where it's concerning, if you're starting to see that trend downward for your company, you're not sure where the warehouse bank's comfort level is, you should be asking those questions of your lenders. Like, we're down to like 6-7 months of cash based on our loss run rate. Is that a concerning level for you? Or are you more like a 5-month person, or is it 10 or 12, whatever that number is? I would just encourage you, if you're seeing a decline, to work with your banker on like what is the comfort level, and if you're starting to get to a level where it's of concern, what's the plan to fix that?
So I guess when in the process do y'all like to be communicated through? I mean, again, I can make my own assumptions, but hearing from y'all, like when in the process, and then also like how what do you want to see through this communication? Like, I mean, pro formas, financials, like in when? I mean, I guess since you're talking, Mark, why don't you jump in?
Yeah, I mean, pro formas are great. I know pro formas are really, really difficult to do in the space. So we don't always expect our clients to put out a 2 to 3 quarter pro forma. But if you have something that's 1, 2, 3 months outlook on what it's going to be like, I would say, as far as the timing of it, I mean, it is obviously like the example Rob gave, where like you're worried about it, and the compliance was due on the 30th, and you end up reporting it 2 weeks late and you're way out of compliance on a covenant, but there was no communication other than just delivering the compliance package to your bank. That's like the worst way to do it. I don't think you need to do it like extremely in advance, but as soon as you're aware of it, as you're filling out your compliance cert, I think it's always best to give the bank a phone call or at least a good description of what the problem was and what you're doing to fix it. And so to me, it's just around the same time that your compliance might be due. And if it's a really big problem, then I think you maybe want to do a little bit earlier. But it's just that if you're out of compliance without the phone call or explanation, sometimes that's going to be viewed negatively by the credit team. And like my job is to try to get ahead of that and manage the credit internally with my credit partners and my clients. So sooner the better, but also I realize you want to have a story around it before you start notifying people of the issue.
Yeah. Thanks, Susan.
I think
That's probably good.
Yeah, I just wanted to tag on to a little bit about that too, just in communication in general, so that I like to always think about having open lines of communication all the way along, that it doesn't need to necessarily be about compliance or an issue. We really like to have that two-way communication going on, even when things are going good. And use your warehouse bank as a resource, because we see a lot of different companies. You're in your company and you're just seeing what's in your walls, but your warehouse banker is seeing a number of other companies and maybe has seen that situation. And so feel free to pick those brains too, of your warehouse bank.
Susan, do y'all like having do y'all have like proactive, y'all do proactive reach outs and communication? I'm sure you do at conferences and all that, but like how do y'all treat that from y'all side too? Do y'all have watch list of clients? Are you proactively reaching out to certain ones? How's that work just overall?
For me, I like to reach out to my clients every 30 to 60 days. Some of them I talk to more often than that, and it might be something as short as a 15-minute call. Yeah, things are going great. We added a loan officer in this area, or it might be something that does take a bigger conversation that, hey, we're looking at adding this particular type of product, or this is something that we're seeing. What do you know about this particular investor? Or it could just be a wide multitude of different issues.
Perfect.
Yeah, Dustin, if I could add to that is, open communication, in our view, it's a two-way street. So we want our relationship managers reaching out to their clients regularly, and we want our clients to feel like they can reach out to our relationship managers or me or Kevin or whoever at Wintrust and have that open dialogue. And so when you have a good open dialogue, you're never really surprised by what happens.
Perfect.
Yeah, it's kind of part of being that good resource, really a strategic partner for particularly an IMB where you're really relying on the capital from the warehouse bank in order to support your business. And so you want to have that good partnership.
Well, yeah, and that's what we usually communicate. Y'all are, if not the most key relationship, one of the most key, one of the top three most key relationships. And like, not having that community, y'all are lending them millions and millions of dollars, not like having that, that open communication, it is an issue. I guess anything, the one thing Rob, Susan touched on a little bit, Mark touched on a little bit, what do you guys think on, just when to communicate and like kind of like the pro forma strategy? Do y'all like to see forward looking stuff? Like, or is it just a basic plan? Like, saying, hey, here's what we're planning to do in the next few months to get back into, what are your thoughts?
If I may jump in on this one is, well, if there's issues, as soon as they're aware of them, we'd like to be made aware of, and we'll work with somebody, 9.99 times out of 10 to resolve that issue. So as early as possible is my suggestion to anybody. I would tell clients, I can never have too much information, although sometimes I regretted saying that because I got every bit of information. But as early as possible in the process so we can work with you. In terms of pro forma, we know it's really difficult to do forecasts in this business, but we just like to see companies do the exercise. So they're looking at a scenario where, okay, here's where I think it's going to happen. This is where I have to have my expense structure. and maybe it'll be better, maybe it'll be worse than that, and they'll have to adjust, but it at least gets folks thinking.
Perfect. Susan?
Yeah, the other thing too, I would say is the closer you are into what you're projecting for, the more detail you can have. We understand that the further out you go, you have a probably pretty good view of what the next 90 days are, but it gets a little cloudier the further out you go. And we understand that.
Yep.
Perfect. So circling back to just what came up. Go ahead. Sorry, Mark. Go.
I think I've kind of already said it, but just maybe clean it up a little bit. I mean, I'm just looking at it as I'm trying to manage the relationship internally at the bank as well. And if I can call my credit team in advance and explain to them, hey, here's what's going on, here's what the issue is going to be when they report compliance, whatever it's going to be. That sounds like it help. I'm on top of my credit. They can tell the communication's there. There's a plan to resolve it. That's way better than waiting and just the problem all of a sudden arises and nobody had any conversation about it ahead of time. So I know we've all said the same thing, but it's like that goes a long way with people, like just to prove that there is open dialogue there.
Yeah, I mean, I think the takeaway from all y'all is just communicate frequently, open, honestly.
Yes.
Yes.
Before there's a problem.
Yes.
And it's a two-way street, though. The warehouse lender should be reaching out and communicating as well. It just shouldn't be us sitting back waiting for the client to call.
We're much more incented to work through a problem than try to work out a problem.
Got it. Well, perfect. That's a great way to put it. Hey, going back to real quick, I wanted to circle back on something we talked about at the beginning, the profitability piece. We got into the communication piece first, but so y'all all said you've seen profitability jump up. Just out of curiosity, I mean, we've seen similar, probably 70%. Actually, probably ours is probably a little bit higher, probably 85% of our clients this year going through the audits, were profitable for the year. Couple part question here. Is that driven? Has origination net income come back? I mean, for a while that was held propped up by servicing. So do you guys feel origination has come back to a positive now for the last year? And then secondarily, I just told you. Let's start there. The origination. So I mean, has origination come back really? And that's where. Secondly, what's driven that? I mean, do we think we're at a level where probably the last 3 years we've talked about just cutting expenses. I mean, are we finally at a level that's kind of gotten our IMBs back to profitability? So, and somebody can jump in. It doesn't matter.
Sure. I'll start out. I'm happy to do that. At least we don't have a ton of clients that are holding servicing. We have a few that are, but not a ton. And one that I just happened to look at the other day, it was remarkable. Their origination volume was almost spot on between 23 and 24. So really no big growth in originations, yet they went from having a 7-figure loss in 2023 to having a loss that was like 4 figures. So, I mean, darn near break even in 2024. And it was all done through cost cutting and margin improvement.
Yeah, I mean, from my perspective, I think companies cut a little bit in 22, thinking it would get better. See it didn't get better, so they cut more in 23, thinking it would get better, and then cut more in 20. So now they're down to bare bones, right? You've cut down to the bone. And then I think margins came back a little bit on production, and that's what really drove profitability, primarily in the second and the third quarters of last year. Fourth quarter, not bad, but and then there's a little pain in the January and February this year. And hopefully, who knows what it's going to be like, but I feel like this year is going to be pretty similar to last year.
So close to break even, maybe making some money, that type of thing.
Yeah.
Mark, I know y'all deal with a lot of bigger service clients have big servicing portfolios, but I mean just similar. I mean have you seen origination income coming up and whatnot?
Yeah, so origination income appears to be positive. I don't think it's like robustly positive, but it's at least not negative. So that's just for the IMBs that are originators only, that don't have the ability to pick up a decent amount of servicing income. So yeah, I would say that's trend that we have seen over the past maybe 3 quarters.
Awesome. Okay.
One of the things we kind of do too when we're looking at those income statements is take out what I kind of call some of the noise. If there were any kind of like ERC or going back to the PPP times, if they were getting that, let's set that off to the side. That's not really operational. I know from the accountants, you're probably going to pull my tongue out. Maybe I won't be invited back again. But that change in the valuation of the pipeline or change in the valuation of servicing, or if you hold marketable securities, the unrealized gains or losses, take some of that stuff out to get down to what is truly kind of like a core operational profit or loss.
Just for the record, Susan, we don't like it that much either, too. It gets more questions than it like. But go ahead. Sorry.
Yeah, and so that's really what we do is we kind of boil it down to what is the true operational profit or loss? Because hey, if you end up showing a bit of a loss, but it's largely due to the fact that you had an unrealized loss on marketable securities, well, is that really something that you were doing, or was it just a point in time?
Got it.
Paper.
Well, actually, I think that's a great. I mean, honestly, jumping around here on our list that I sent out before, but you give a great segue into something else here. So, speaking of those, those valuations, the fair value stuff. I mean, 90% of the balance sheet's on fair value, and the rest is cash, basically. So, like, I mean, how do you guys, from a warehouse perspective? I mean, starting, I guess, with like the derivative side, the pipeline and whatnot. How do y'all look at those valuations? Do you remove those out of different calculations y'all are doing? Do you discount them? I mean, what do y'all like kind of just?
I'll jump in. So for balance sheet purposes, for tangible net worth calculation purposes, we take them at book value, but we do some analysis around them to make sure that they're reasonable. And when we really, what we do is and I know this is not cash flow lending, it's more collateral lending, but we really boil it down to true cash flow. Like, what do you have coming in actual cash? And so we'll back the non-cash movements out of that number, like Susan was talking about, just to get down to a base operational cash flow.
Got it. Mark, how about you? What do you, anything?
Yeah, same. I mean, I've been at 3 different banks, and everybody's trying to boil down that operating income number to more of a cash basis. And so, like you said, we have a lot of decent sized servicers. There's usually a pretty large swing sometimes in the market SARs. That 100% gets taken out. And a lot of IMBs over the past 2 years have been selling MSRs. Sometimes you take a lot. I mean, it's a good economic trade for the company, but you might take a loss on the sale. Well, that's like a one-time non-recurring adjustment. So we would adjust it like that as well. But we're really trying to get down to the cash number, just like Rob and Susan had said. I think most banks are doing it that way.
Got it. So see,
one other thing, Dustin, that we do that, because one of the covenants we have, as far as liquidity covenant, we use a working capital covenant. And so one of the accounting treatments is around the lease space, and the right of use is booked as an asset, and it's a long-term asset, but then a lot of times the liability, the lease liability, there's a current portion and a long-term portion. We just take the amount that's in the current portion of the liability, we take that out so that it doesn't impact the working capital ratio. So
got it.
For any of the accounting nerds that are on the call.
I was going to say another goofy accounting pronouncement out there, but that's affected everybody's world over the last couple of years. I guess back to the MSR valuation piece. What over the last couple of years, this has kind of been an interesting issue, at least from us, and want to see what y'all are thinking about it. We'll see. To kind of to Mark's point, we'll have valuations that are on the books. And I think I won't get into it that much, but I think everybody realizes. On the books, it's supposed to be a fair value. Fair value is different than market value. Fair value goes in, it's a level 3 asset. It goes into discounted cash flow, stuff like that. But a lot of the times, the market value is lower. So I guess it can be significantly low. To Mark's point, you could have these big losses if they try to go sell it because you have marked at something, and then. So I mean, I guess this may be just a thought, not necessarily, but I guess Susan and Rob, are y'all doing similar things, basically taking all of that stuff out? I mean, if they had it marked at 150 basis points and they sell it for 100, I mean, are y'all taking that one-time loss out of your analysis? How are y'all treating stuff like that?
That is exactly what we're doing.
Yeah, But sometimes it depends on the situation. If a company is short on liquidity and they're going to need to sell their MSRs, but it's going to be much less than what they have it on the books for, we're really okay with that. We'd rather see the liquidity than and not worry about the book loss.
Mm-hmm.
Got it. Got it. Susan, you said basically similar.
Yeah, definitely. And again, we don't have as many that are doing that. One of the things we also kind of watch though is what portion of their equity is their MSRs. We might look at it closer the larger that gets.
No, that makes sense. Yeah, for us, it's always puts us in a weird spot because, like, we have clients that want to be conservative and they want to mark it down, which typically we're not going to have that big of issue over that stuff. I mean, if they want to mark it down and be conservative, technically it's not fair value, but it's probably a better representation of what the financials actually look like. But we also have other clients that, the one thing we do consistently preach is consistency. I mean, they can't be marking from period to period, low end of the range, high end of the range, down, because then you're managing earnings and managing your equity through, really fake adjustments, not just, not just cash to, non-cash stuff. This is like real, so that's the one thing we really try to monitor on our side. So.
Yeah, as bankers, we prefer lower of amortized cost toward market.
Well,
you don't see that very often anymore.
I was going to say, unfortunately, in this world, you don't see that very often anymore. So, I think most people just have moved to fair value just because of the ease. I mean, you're basically then just marking it every month, and that's what you're doing. Instead of having to track amortization and track all this different stuff, you're basically just getting evaluation and marking it. So, okay. I think, kind of changing topics a little bit. Just we touched on this a little bit. We touched, when we're talking about communication. Just overall, when y'all are looking, at clients, new clients, existing clients, like what are you looking for from your clients? I mean, again, we talked a lot about communication. Is there other things that y'all are like keying in on that you're really looking for when you're picking up a new client or you want in an existing relationship? Anybody can jump in.
Yeah, I can take that one first. I mean, I would say it's been interesting, really, because a lot of IMBs haven't been profitable. If you go back to 2023, and maybe there was like 8 or 9 quarters there, it was pretty tough. And you're trying to add a warehouse facility where you're coming off of maybe 4 or 5 consecutive quarterly losses. So it's been a little bit different than it ever has been. But I mean, ideally for us, we want to see like maybe 5 to 6 months of consecutive profitability. And if you don't have that, then we're looking for the story about how you're going to get there. And the story can't be, well, we think rates might drop 50 basis points and we'll pick up some volume. That's really not going to work. Are you adding some really quality fellows? The expense side, what are you doing there? Like a true story about the company's projections to get there that we can believe in. And if you have that, then we can kind of take it from 6 months down to maybe 3, a good plan to get there. So that's probably the biggest deal. And just having some. I mean, net worth is not a huge deal for our bank. I mean, we don't have really a line in the sand where it's too small, but the leverage needs to be right. And if you have MSRs, are you leveraging that? And if you are leveraging that, how much? I mean, we provide MSR financing, so we're not necessarily against leverage, but we don't want it to be over leveraged, so to speak. So, I mean, I think the profitability trends has been the most difficult part of it over the past year or two, just because that's been the biggest challenge in the space. And that's kind of what we're looking for to kind of get in the door.
Got it. Okay. Susan, thoughts?
Yeah, I think I'm going to tag off a lot of what Mark said is that, hey, we'd like to see that you're at least kind of at break even. And if you're not, what is the plan to get there? The other thing too would be, I think it's become more important is we'd like to see a deposit relationship. Might not be pledged, but hey, as a bank, we like to have those deposits. It makes it easier to lend out. And so I think it's just been an increased focus for us on that. And I think the other thing is just the approach that the prospect is taking. We want to be a partner and we want to have that two-way street communication and not just be a commodity.
Perfect. Perfect.
I'd agree with both Mark and Susan. Some additional things we look at are, what's the longevity of the company? Have they been through previous downturns? Same management team? Maybe not requiring 6 months or 3 months of income necessarily, but a real positive trend in making sure they have the liquidity, as I mentioned before, to kind of ride out the storm. And of course, strong ownership, great reputations, all those kinds of things, good collateral, repurchase history is good. Those are really, along with what Mark and Susan said, what we're looking at.
The last thing I would add is we talked about the cash quite a bit, but it's around managing the losses and how much cash is on the balance sheet to cover those versus the expectations. So a good cash flow analysis that would need to be done to make sure you have enough. And like for a new company, I think if you have cash burn going on, if that's under like 6 months, that's probably difficult. I mean, it's going to take me 45 to 60 days to add the warehouse line on. So if you only have 4 or 5 months of cash before you burn through it all, that's a pretty low number to start a new relationship. You want that to be like closer to maybe 12 months. But anyway, that's stuff we can work through, but those are just some general guidelines. I mean, cash, you continue to cover the losses, how long the loss is going to last, which gets to my earlier profitability point.
Perfect.
Yeah, that makes sense.
Similar discussion. We talked about this on our last one 2 years ago. Similar, when we're talking about other counterparties out there, probably I would imagine one of y'all's bigger counterparties you're looking at is the investors and whatnot. What are y'all looking for there? I mean, there's a few big investors that went out of business. Again, I think it was 2 years ago when we did this, like right around that time. A couple went out. So, and Susan, you kind of hinted on this earlier. Like I think you even brought investors up, and said some of the to ask us, reach out, stuff like that. I mean, what are y'all looking for in counterparties? Do y'all do much due diligence in the counterparties? What kind of guidance do you give IMBs, that kind of thing? I guess, Susan, why don't you jump in?
Absolutely. As far as the investors go, really, I don't think we're looking at anything any different than the mortgage originator should be. It's you who's selling the product to this investor. We like to look at financial statements, but really, you should be looking at those too. Also, understand their performance, because really the big thing while you're looking at them is you want to have them be able to buy whatever it is you're selling them, and you want to be able to get the cash back. So how do they perform? What do they do with the notes? Do they have them go to a custodian? Do you ship them directly to the investor? There can be different things with that. So those are some of the things that we talk to them about. Same thing with title companies or closing agents. Are you vetting them? Are you getting CPLs? Are you using a service like that will vet those title companies and closing agents? And then I guess even to jump, I realize I'm kind of going all over the place, to just other vendors that you're working with. Make sure that they specialize in the mortgage industry, from the people that are providing like your E&O and your surety bonds. You might have a brother-in-law that sells insurance and you think you're getting something that's covering you as a mortgage banker, but no, it doesn't cover closing loans in your own name. And then here's my shameless plug for CWDL, accounting. Accounting for the mortgage world is different. We've seen people that are CPAs that have come in and they really need somebody like a CWDL to come in and really help in translating mortgage world into accounting. And then it's really also having that strong internal accounting system so that you can get the timely reporting and you can get the loan level, branch level, LO level information that's out there. So sorry about that. I kind of went off on a tangent.
Well, no, thanks for the plug there. But Rob, thoughts?
Yeah, I mean, we like to really work with well-established, well-run IMBs. And so we actually have a fairly hands-off approach. We feel that our interests are aligned, and these companies want to work with great investors. They want to work with good title companies. It's within their interest. It's within our interest. So we really have a trust with our relationships that they're doing what's right for them. And then we can see that as loans turn through the line, and you can see trends. If you can spot a trend of something's going wrong, and you can talk to them about their investor. But overall, we really leave it in their hands to run their business the way they feel fit to run their business and work with who they feel they should be working with.
Perfect. Mark, anything you want to add there?
Yeah, so we actually do approve investors at the bank. It's not a deep dive. It's not a very difficult or very long process for that matter. But I agree with Rob. The IMB is probably more interested in that than we are, so they're probably doing their own work around that. But we did add an example. We do some facilities for aggregators where they're, the loans might be on the line for 180 days or even longer. And we got notified late that there was a new investor. And so we get the financials and it's like, well, the trade, I think was like an $80 million trade. Our first question, how they going to buy the loans? They don't have enough cash for that. And then they didn't have the cash. So the trade falls through. We're talking about that company about a warehouse line now, which we couldn't get there on. So it was the problem that causes. Now we have loans that are about to hit their max dwell. So we have to resolve that issue, which is just extending the dwell. So it's not a big problem, but how long are you going to need to extend it, bring in a new investor? So not everybody does the work that needs to be done around them. And it's just, I do get a lot of times, why do you guys care? They're going to buy the loan. And it's not your problem. It's off your line. Well, I got to make sure they can buy the loan, right? And that they can continue to buy loans. But typically, I've never had a problem with that in my entire career, except for that one example. But so that's why we don't do a deep dive into the investor. We just try to make sure, quick look at the financials and make sure everything's fine.
Okay. Perfect. Well, thank you. So I think from here, I just have some just minor topics just to kind of run through. I wanted to kind of get through here in the last 15 minutes or so. Just kind of more rapid fire type things. I guess starting off, we talked in our planning session a little bit about e-notes, or more efficient delivery types. E-notes have been around for a while. Are y'all seeing any pickup in e-notes or closings, anything like that? What are y'all seeing there on that side?
I could jump in. Yeah, Wintrust definitely warehouses e-notes. Going back to my Comerica days, I saw a bit of a pickup in e-note volume during the pandemic, 2020 and 2021. And primarily, I believe the reason for that pickup is most of our clients knew that their loans were going to Fannie or Freddie. And it made it easy to close an e-note. And then once that dynamic kind of shifted into the down cycle, and it became more attractive to sell to the aggregators, well, then it became more difficult to originate an e-note because they didn't know where it was being sold on the date it was being originated. And each aggregator kind of has their own different tri-party agreement. So it's a very small fraction of what we do here, unless a company is basically selling most of their stuff to the agencies.
Got it.
I would agree with what you're saying, Rob. Yeah, we definitely will warehouse them here, but it just doesn't seem like the best execution is out there yet for the e-notes.
So I advanced notice on this question, so I did pull some stats for you. So we have 65 warehouse borrowers, and 13 of those customers are approved for or actually using e-notes in our book. And we like e-notes. It reduces risk, it saves cost. But if you look at just our portfolio, 10% of the collateral that we processed in 24 was e-notes, and then that was up like 10 times from 23. So there's not a lot of activity, but it is 10 times more than it was the year before. And we think in 25 it'll be maybe maybe 30% of our collateral come through e-notes. But
really,
wow.
Yeah,
that's a lot. Yeah.
So we have I think 8 investors that are approved to purchase e-notes. And so, but like I said, it's only 10% of our volume, but it's not huge, but it is increasing year over year.
And Rob, you touched on a little bit, so you talked about, what is the holdup with e-notes? You think, especially moving into new generations of buying homes, doing stuff on phones and stuff like that, you think it'd be a lot more popular than flipping through, 200 pages of documents. What do you think the holdup really is?
Yeah, I think it's less about, the younger borrower wanting to have it more efficient, and it's more about execution in the back end. and having all the participants being able to accept it. I mean, you've got the closing agent, you've got the warehouse bank, you've got the custodian, you've got the investor, all these things, they all have to be in agreement and in alignment. But to me, the key driver is, and I'd be interested to hear Susan and Mark's opinion, but it's more about best X. So, most of our clients are macro hedging their pipeline and then their unsold loans. And when they get on the warehouse line, they don't know quite yet where they're being sold until they run them through a best X model, and then they send them out. Well, you would have had to have closed it under the agreement you have, with that aggregator, if it's not Fannie or Freddie, and every agreement's a little different. So it just makes it more difficult to actually close, unless you know upfront at the time of origination where you're going to sell it.
Got it.
I would agree with what you're saying. And the other thing too is that at a time when cost cutting is having to go on in all of these mortgage companies, you really almost have two processes. You have the e-note process and you have your regular paper process. And you're asking your ops people to deal with two different processes at a time when you're shrinking those departments down because you have to save costs. And so I think that also impacted some of that as well.
Yeah, you have 10 initiatives and that's not your number one.
Right.
I think that's the issue with some of the investors. It's only going to be 5% of the volume that they buy, and they have 10 projects they're working on, and that one just never makes it out of number 10. It's always number 10. So, and the investors haven't fully adopted it. That's probably one of the bigger issues, and I don't know. We are seeing an increase in it, but it's still not significant.
Got it. Okay. Going down just again these kind of other topics. Mark, maybe you talked about this a little bit on the beginning, so maybe you can talk a little bit about it was a question that came up specifically on the SPV SPE structure. You said you've done a couple of them. Just I mean, what I guess more from in terms of what to look out for out there. I know we talked about cost, different things like that. I mean, any thoughts? It was a specific question from somebody on the webinar, so I wanted to make sure we addressed it if we could. So
yeah, I mean, so a lot of the larger banks are already doing the bankruptcy remote structure, and the benefit to the bank is that we're basically using 100% risk rate capital. When we do a warehouse line, if you can put it into this new SPE structure, you can drop that by 50%, sometimes even more. So you could, that's pretty advantageous to the bank for one, and it also could be advantageous to the IMB. We could either do larger lines because of that, or potentially maybe even adjust pricing a little bit because of the lower capital. So that's all wonderful. The issue might be that there's legal costs and all that. You set the SPV up. There's a different set of legal docs that have to go along with that, and they're a little more robust than a typical warehouse facility. So the legal expenses are pretty high, and so because of that, we're just now starting to do them. We have our first one underway at the moment, so we're really focused on lines that are probably 150 million and above, and that could trickle down to lines below that at some point. But like I said, we have 65 borrowers, so we're going to kind of do them 2 or 3 at a time, and then we'll see how it goes, and then we'll kind of take a step back and see if we want to go deeper into the portfolio as far as line size go. But I think for right now, given the legal cost, it just needs to be a little bit larger facility.
Yeah, and so just to clarify too, they set up a brand new entity, right? And the entity's owned by the IMB or the mortgage company, and you guys are technically then lending to that new entity. But for financial statement purposes, it all works basically the same. I mean, the entity, it all consolidates up into the mortgage company and whatnot. It's just really, you have this new entity, and that's where a lot of the cost and headaches and stuff like that come in, right? Mark,
it's a new entity, and the way the mortgages flow is a little bit, I mean, it's basically seamless for the IMB, but the legal document structure, there's participation for certificates that are out there, and maybe a trust that some people go through, depending on how you have it set up. So there's just more legal work, but really the mechanics and the flow is exactly the same. Like you said, it all consolidates back into the same company. The way we fund loans, the way we interface with the company is all exactly the same. It's just really a legal document that puts it into a special purpose entity, and so it's not really, it's a little bit different mechanics from a legal perspective, but not from an operational perspective.
Got it. Okay. I mean, anything, I know Susan, Rob, y'all didn't have much to say before, so I don't, but if you anything y'all want to add? Or
no, at this time, we're not considering any SPV or SPE setups. Okay. Our facilities run anywhere from 10 million to 150 million right now. So we're probably not even at that large break point where, as Mark was saying, it probably only made sense for lines 150 and up for them. So it's not being discussed with us at the time.
Got it. Okay.
And we're the same as Rob.
Okay. Okay. A couple questions that we actually got pinged in that I want to just cover real quick. Back to the investor questions. Do y'all, I mean, when we talk about investor, due diligence, counterparty risk, do y'all monitor like investor concentration? Like, I mean, if they're selling everything to one investor or two or whatever, are y'all putting any kind of limitations on that, or go ahead, Susan.
We don't have any formal limitations on it, but we monitor, concentration, and as part of that open dialogue that we were talking about before, that would be something we'd ask about. And, do they have other places they can sell it? Why are you just selling it to these folks? It's more about just knowing your customer and having the communication.
Okay.
Prompted discussion.
Okay. Okay. Mark, anything to add on that?
Not real. I mean, so the answer to that's really no, but we would have some investor limitations, not for any particular client, but just if we view the investor to be maybe a little bit, maybe their financials aren't quite as strong, we want to put a limit on that for the entire portfolio. And that's just more of a trigger for us to be, hey, look, this company reached $20 million across our portfolio, just to stay on top of it. But it's not really a client specific limit. It's just more of an investor limit for our entire portfolio.
Okay. Another question that somebody had. So, this is an interesting one for me. So, basically the questions, you can get a wide range of, bookkeepers, controllers, financial preparers out there. How do y'all evaluate, when you do see obvious, blatant, issues? I'm assuming it probably happens more, probably Susan, in your lower book, Rob, maybe on y'all's lower end, maybe some Mark on your lower end too. But I mean, what are y'all doing in those situations? Like how are you making decisions if you know stuff's blatantly wrong in financials, I guess? Susan, why don't you jump in?
Yeah, I mean, we could see it all across the board. Obviously, we have an area where a lot of the clients, we call them emerging mortgage bankers. They're learning this. They're getting into this, and so some cases, we'll see financials that we know that there's things that are missing. We really try to guide them to somebody like CWDL that can do the basic blocking and tackling bookkeeping work with maybe the overall intent is eventually that they'll transition to where they'll have their own bookkeeper doing those things. And with CWDL's help, they can transition and get the accounting software, for instance, set up. But yeah, I can't stress highly enough how important it is to have that good reporting, whether you outsource it or you have it internally. It's just so important for running your business.
I feel like it would be our obligation, if we're looking at an audited financial statement from a firm that's maybe not as well versed in the mortgage business, and say, part of that open communication, our duty to inform the client that, hey, this CPA firm isn't up to snuff, and they're not doing you any favors. You're not getting favors by having them, and make a few recommendations like your firm, Dustin, to maybe talk with you guys, and so they can up their game. But I feel like, again, it's our duty to point that out. We do them no favors by not telling them.
Yeah. Okay. Mark, anything to add on that, or?
No. I mean, the only time I've seen it maybe be an issue is if a company's entering into a new, like maybe they're entering into mortgage servicing rights, they're going to start retaining. That's a whole kind of a different accounting mechanism, especially if you're doing the whole, the new trend with the investor is taking the excess spread of the servicing right. That's even a different accounting mechanism. So, when you're doing that, you probably want to get some advice from an accountant on how to the right bookkeeping for all those transactions, because it is complicated.
Okay, we're obviously wrapping up here. We got about 6 minutes left. Just one other main, just quick M&A activity. What are y'all seeing out there? I mean, are y'all seeing much? Is it picking up, slowing down? Have you seen much over the last, 2 years ago when we did this, Susan, it was like very hot. Yep. So yeah,
I'm still seeing it. It's maybe not at the pace that it was 2 years ago, but it's still out there. I think it's probably going to continue. And so I think it brings it back to what we first talked about, just that importance of getting yourself to break even. If you're a break even, maybe you can be an acquirer, but also from the other standpoint, really important to get to that break even so that if you decide you want to be acquired, you've had enough fun in the mortgage space, you can put yourself in the best light to be able to get that best price for your business.
Rob.
As far as I'm concerned, I mean, the companies that are left are probably the survivors, but there still will be some to tap out, especially given recent goings on with the rates and the volatility. And it doesn't, like, I think the phrase last year was survive till 25, right? And 20,
Here we are.
20, and here we are. Woo! That was worth the wait. But now it looks like it's going to be a little bit more like last year, and that will probably push some folks to want to sell. But for the most part, I think the survivors are out there right now.
Perfect. Mark, anything you want to add there?
Much more. I mean, in 23, I think we saw more of it. Even inside of our portfolio, we had clients that were merging together either because of issues or just they were coming together as more of a mutual merger of equals. It's been a little bit less, but I agree. There's still some going on.
Okay. And then I think really the last one we'll end here with, it kind of wraps in a question somebody asked and one we talked about. So giving you an out if you don't, we've obviously had some volatility in the warehouse space. We have people leave. We've had, two big ones leave since the last time we did this. This came up as actually was brought up, I can't remember, on the warehouse, on the prep call, just overall y'all's commitments and the strategy to the, to stay involved in the industry, support the industry. The question we got that kind of ties into this is like, are y'all doing any things in terms of pricing or capacity, strategies to respond to competition? So two-parted, y'all can go with however you want to. We got about 2 minutes, so everybody, however y'all want to answer. So
One of the ways that we're looking to do that is just integrating our warehouse system with our client's LOS so that it makes the funding, the request for shipping, the settlements as efficient as possible. So really just trying to meet them where they're at.
Awesome. Thanks, Susan.
Mm-hmm.
Rob?
Yeah, well, in terms of dedication to the industry, Wintrust has been in the warehouse lending business since 1995, so they've got a lot of experience. They've always wanted to grow nationally, and when the opportunity came to pick up my team, they were able to then take advantage of that to kind of grow nationally. And nothing says dedication to the business to me more than picking up 6 people with no guaranteed portfolio behind them. So they were ready to roll, and they've been good to us, and we've had some very significant success. So I think Wintrust is very dedicated to the space, very competitive as well to try and help our customers become profitable.
Awesome. Mark, you want to wrap up?
Yeah, sure. I would just say as part of your risk management, you should understand your bank's financials. I mean, I think every bank is in the space until they're not. And a lot of times, even the people you're talking to don't know about it until a few days before. So the more you understand about the bank's liquidity, and unfortunately for our space, like warehouse lines are short term and the rest of the bank's exposure is longer term. So when they decide they need to reduce the balance sheet, a lot of times our groups are the ones that get asked first to reduce. So I think over the past, since the regional banking crisis, really, I think a lot of my clients have become more educated about what a bank's supposed to look like and what the ratios should be. And I think that is a good risk management technique to understand everything you need to know about a bank's balance sheet and income statement.
That's a great point, Mark. Yeah, absolutely.
That's a very good point.
Awesome. Well, thank you all. Casey's going to kind of wrap us up, but thank you guys again for having a great one.
Thank you.
I don't know if any of us have watched it. We've had attendees and we've had them stay on, which is the nice thing. Everybody stayed on, everybody stayed active. So thank you all. It's been definitely a popular one. So go ahead, Casey.
Thank you.
Yeah, no, that was great. Thank you all. Susan, Rob, Mark, that was really a great conversation. And Dustin's right. We had a lot of people stay on. That said, at the end of this, there will be a quick survey. So if you all don't mind taking it, it just helps make sure that we're bringing you guys relevant information. We appreciate everybody's time. And happy almost Easter, everybody. I hope everybody
Yeah.
has a great day.
Welcome to spring.
Thank you.
All
Yes,
right.
indeed.
Thanks,
Take
y'all.
care.
Thank you. Bye-bye.
Bye.